everyone, welcome back to the deep dive. Today, we're diving into something that's been, well, let's be honest, kind of freaking everyone out lately, the markets,
Yeah, things have been pretty wild out there, haven't they?
to say the least. And, for anyone who's newer to investing, this might feel like their first, well, market crash.
Hmm.
It's enough to make anyone a bit queasy.
Yeah, definitely can be. It's understandable to feel that way, especially with all the headlines screaming about corrections and downturns.
Right. So today we're going to try to cut through the noise. We're digging into this, let me see. This piece is called Le crash du marché de votre vie.
Catchy title, right?
Very dramatic. Don't worry, we're not predicting the end of the world. We're actually going to pull out the key insights from this to help you understand what's actually happening during these volatile periods, why they happen, and, crucially, what you can do about it. How to navigate it all without losing your cool or your shirt.
And maybe even, dare I say, spot some opportunities.
Exactly. So we'll be looking at how the market behaves when things get rocky, the role our emotions play, which is surprisingly huge, and why trying to time the market is, well, probably not the best idea. And we'll dig into some history to give us some perspective. So where should we start with all this?
Well, I think a good place to start is to actually understand what we mean by market volatility.
Okay, so when we hear volatility explodes, what's actually happening?
Basically, it means we're seeing really sharp and often really fast declines in prices. Mostly, we're talking stocks here, like, those big drops that give you a heart attack when you check your portfolio.
Yeah, those. And these are what, like corrections?
Right. Usually when the market drops 10% or more, that's considered a correction. And then, of course, there are the more serious crashes. But essentially, volatility just means the market's taking some pretty big and sometimes totally unexpected turns.
Okay, so that's what it looks like. But what actually sets it off? What triggers these chain reactions?
Well, there are a few common culprits. Big economic shifts are a big one, like if inflation suddenly spikes, then central banks start hiking up interest rates. And that can spook investors because they worry about, future economic growth.
Makes sense.
Then there are geopolitical events, like international conflicts, or even just big political instability. That injects a lot of, fear into the markets, makes things unpredictable. And then there's always the wild card of government policy changes. When those come out of left field, investors can be caught off guard, and that can lead to some rapid adjustments, let's say.
Yeah, we've certainly seen a mix of all that lately, haven't we? And it's not just individual stocks that feel the impact, right? It's like the whole market takes a hit.
Right. Those major market indices, think the S&P 500 or the NASDAQ, they really feel it because they're essentially a collection of stocks representing a whole segment of the market. So when those indices swing wildly, it's a pretty good indication of overall investor confidence or lack thereof.
Especially the NASDAQ, since it's so tech-heavy.
Exactly. Tech tends to be a bit more sensitive to these kinds of shifts. Now, speaking of fear, our source talks about this thing called the VIX index. They call it the barometer of fear, which sounds pretty ominous.
A bit dramatic, maybe. For those of us who don't speak fluent finance, what is this VIX thing? What's it actually measuring?
So the VIX, or the volatility index, basically tells us what the market expects volatility to be over the next month. It's calculated based on the prices of options contracts for the S&P 500. You can think of options like insurance for investors.
Okay.
So when people are nervous about the market, they tend to buy more of these insurance policies, these options, and that drives up their price, which in turn pushes the VIX higher. So basically, a rising VIX means investors are getting scared.
Got it. So when we see the VIX climbing, it's like the market's collectively holding its breath?
Pretty much.
Okay, so we're getting a clearer picture of what happens when the market goes haywire and some of the reasons behind it. But this next part is super interesting, and it's something our source really emphasizes: the role of emotions in all of this. Apparently, we humans aren't quite as rational as we like to think.
Not when it comes to our money, that's for sure. It's amazing how quickly logic goes out the window when you see your portfolio shrinking.
Yeah, you see red and suddenly you're not thinking straight.
Exactly. And that's where a lot of investors trip up. They let their emotions, mainly fear and anxiety, dictate their moves, which often leads to selling at the worst possible time.
Like that classic fight or flight response, but with your investments.
Right. And our source points out that this is especially dangerous for newer investors. Now, if you haven't been through a major market downturn before, it can be really unnerving. It's like being thrown into the deep end without knowing how to swim.
Right, you haven't built up that emotional resilience yet.
Exactly. So Learning to stay calm, to not panic and make impulsive decisions, that's key. And that applies to everyone, not just newbies.
So basically, don't bail out when things look bad, but also don't get too excited when you see a little upswing.
Exactly. Because trying to time the market to buy low and sell high, well, it's pretty much a fool's errand.
Yeah, that's what our source calls an illusion. The illusion of market timing. Why is this so hard to pull off?
Well, think about it. To time the market perfectly, you have to correctly predict both the absolute bottom and the absolute top of the market cycle.
Which is pretty much impossible.
Pretty much. Even the most seasoned investors can't consistently do that. There are just too many factors at play, way too many unknowns. And often, by the time you realize the market has bottomed out, it's already started to rebound.
And vice versa, right? If you wait to sell at the very top, you might miss out on a lot of gains and end up selling on the way down.
Exactly. And our source actually cites some pretty compelling evidence against this strategy. Studies have shown that if you miss just the 30 best trading days over a longer period, your overall returns could be slashed by, get this, 83%.
83%, that's a lot.
It is. And it really drives home the point. Staying invested, even through the rough patches, is usually the better approach. Trying to time the market is just too risky.
So basically, instead of trying to be a market psychic, we should just ride the waves and trust the long-term trend.
That's the idea. Of course, easier said than done when you're staring at a sea of red, but it's important to remember that the market has always recovered in the past.
Now, to illustrate this point about not overreacting to short-term market moves, our source talks about a recent event, let's see, the second largest bullish day in NASDAQ history.
Oh yeah, that was a big one.
On the surface, that sounds great. Like, okay, things are turning around. But the source is quick to warn us against reading too much into single-day gains like that.
And rightfully so, because we've seen this before. It's a classic bull trap. Big up days can happen even when the overall trend is still down.
Like a dead cat bounce, right?
Exactly.
Yeah.
And a perfect example is the 2008 financial crisis. Back then, there were several really strong up days, even for the NASDAQ. But they were just temporary blips. The market kept falling for months after that.
So a big green day doesn't necessarily mean the coast is clear.
Nope. It could just be a brief pause in a longer downtrend. The real bottom might still be a ways off.
That's a good point to remember. Don't get lulled into a false sense of security.
Exactly. It's all about keeping the big picture in mind and not getting too hung up on day-to-day fluctuations.
Okay, so we've talked about the challenges and the emotional roller coaster that comes with market volatility, but our source also makes this interesting argument, and I'm curious to hear your take on it. They suggest that these periods of turmoil can actually be good for investors.
Well, in a way, yes.
That sounds a bit counterintuitive, to say the least.
I know. It's kind of like saying, hey, this fire is a great opportunity to roast some marshmallows.
All right.
But hear me out. Recessions and market crashes, while obviously painful in the short term, often create some really amazing opportunities for those who are, let's say, strategically minded.
How so?
Well, when everyone's panicking and selling, the prices of a lot of great companies get driven down,
Yeah.
sometimes way below their actual value. So for those with a long-term view, it's a chance to buy low, like really low.
It's that be greedy when others are fearful. Like, right. But it takes guts to do that.
It does, and it requires patience, because it might take a while for the market to recover.
Hmm.
But history shows that it always does eventually. And those who bought during the downturn, they're the ones who reap the biggest rewards.
So it's all about taking advantage of those temporary price drops.
Right, and it's not about trying to perfectly time the bottom. It's about recognizing that when the market is down, there are bargains to be had.
Okay, so there's potential upside, but it's still scary. I mean, how do you know when it's the right time to buy? How do you navigate all that uncertainty?
Well, that's the million-dollar question, isn't it? The source acknowledges this dilemma. You're constantly weighing the risk of the recession getting worse against the potential reward of buying in at a discount. There's no easy answer.
So no magic formula.
Nope. But that's also why it's important to have a solid investment plan, to know your risk tolerance, and to have a long-term outlook. If you're constantly reacting to the headlines, you're going to get whipsawed.
Okay, so keep calm and carry on investing, basically.
Something like that. Now, speaking of long-term potential, the source also points out the resilience of certain companies, particularly in the tech sector. Even during recessions, these giants like Amazon and Google, They seem to just keep chugging along.
Yeah, it's like they're in their own world sometimes.
Right. And that's because they're constantly innovating, constantly investing in the future. Think AI, cloud computing, all that. They're not just weathering the storm, they're using it to their advantage.
So even though the market might be shaky, these companies are still looking ahead, building for the future.
Exactly. And that's a good sign for investors. It suggests that these companies have the strength and the vision to come out of a downturn even stronger.
So for those building a long-term portfolio, maybe these are the kind of companies to focus on.
Potentially, yes.
Yeah.
Of course, diversification is always key. But companies with strong fundamentals, a track record of innovation, and a solid financial foundation, those are the ones that tend to weather the storms best.
Makes sense. So to wrap it all up, what's the key takeaway from all this?
I think the biggest lesson here is the importance of staying calm. Don't let your emotions drive your investment decisions.
Right. Don't panic sell.
Exactly. And remember, market volatility is normal. It's part of the game. It's about having a solid plan, sticking to it, and not getting spooked by the headlines.
And focusing on the long term.
Absolutely. Short-term thinking will just lead to bad decisions.
So, as a final thought for our listeners, instead of fearing market volatility, maybe we should think about how to use it to our advantage. Think back to those historical trends. Think about the resilience of innovative companies. There's opportunity hidden within the chaos. You just have to know where to look. And remember, stay calm, stay informed, and stay invested.
Well said. Thanks for having me.
Thanks for joining us. We'll see you next time on The Deep Dive.